Hi, and welcome back to the Business Career College video series. In this particular video, we're going to look in very broad strokes at buy-sell agreements. Now, what a buy-sell refers to, it's essentially like a prenuptial agreement for a business. So the idea here is we are going to establish some certainty. We say, what if something goes wrong in the business? And the most common, or maybe the best way to handle this, is we have an agreement written into our unanimous shareholders agreement. So the USA, or the unanimous shareholders agreement, says, look, if something happens to one of our shareholders such that this person can no longer continue in their capacity as a shareholder, then we're going to set the conditions of sale. And when we say conditions, there are a few things we're going to establish here. We're going to establish either a price or a valuation formula, and I'll talk about that more in a few moments here. We're going to establish who the buyer and seller will be. And we're going to establish some time frames here. There is some other considerations here. Tax consequences, for example, which we're not going to deal with much in this video, but we will deal with in a later set of videos, can be quite important to address. And in fact, there are some very complex tax cases that specifically deal with the outcome of a buy-sell agreement. So let's look at what some things are that can go wrong here. There's a whole bunch of stuff that can go wrong that could force a business owner to leave. We could have the death or disability of a business owner. We could have a divorce. Sometimes a divorce can compel a sale of shares under an unfortunate or unplanned set of circumstances. We could have a personal bankruptcy. And in a personal bankruptcy, the trustee in bankruptcy is going to step in and say, hey, I need those shares that you own personally. We're going to have to go find a buyer for those. And if we have this covered in a USA, we can often restrict who the buyer would be and create a fair price for that sale. We might be looking at somebody who is convicted criminally. And if it's a conviction like a fraud, for example, this person might not be welcome as a business owner anymore. They might be forced out of the business. We might have somebody who loses their license to practice in a particular business. For example, a doctor who's a partner in a medical practice or who's a part shareholder in a medical practice might lose their license and then be prohibited under the terms of their provincial legislation, the Medical Professions Act, or whatever provincial legislation happens to be in place that says, hey, you can't own shares in a medical practice anymore. We might have somebody who becomes non-resident. It might not be a concern, but it could be an issue where we have to, for some reason, maybe a regulatory reason, keep the business as a resident of Canada, and now one of our shareholders is going to become non-resident. This person might just say, hey, I've had enough, and they're going to retire, or we're going to execute some sort of succession plan. We could have somebody who is deemed incompetent, depending on the nature of the business legally incompetent, meaning they can't make decisions anymore. We might have somebody who maybe violates a morals clause. Of course, recently in the news, we've had the Jian Ghomeshi issue, and if you had a business partner who ended up in a scenario like that, you might not want them in your business anymore, depending on how sensitive your business is to public perception and so forth. We could have a variety of issues then that we see here, and this is just a sampling, there are several others. The concern here then is one of these things goes wrong, and we say, now what happens to those persons' shares, to their interest in the business? So are we going to sell them on the market? And that might not be attractive, especially in a closely held business. Are we going to sell to other shareholders? So if there are some other shareholders, are they the ideal buyers? And one of the key limitations we sometimes see here is that the remaining shareholders, they might not be excited about doing business with the family. So let's say that we have a death here, and we can see some very easy sort of complicated outcomes here. Let's say we have a business here. We've got a 50-50 business. We've got Bill and Susan, and they each own 50% of a business. And they're both married, but not to each other. Bill is married to Brenda, and Susan is married to Sam. And let's say Bill dies now, and initially his shares go to Brenda, and now Brenda's a 50% owner of this business, and Susan now is in partnership, or whatever we want to call it here, with Brenda. They both equally own shares of this business, and Brenda may not know anything about this business. She may not get along with Susan, and we can have sort of a double-edged sword here, where Susan might have all the bargaining power. She might be the one with actual cash here to deal with. She controls the business. She might be able to hold Brenda over a barrel and say, Brenda, the longer I hold out here, the less those shares are worth. You can go and try and find another buyer. But after a year or two, or if I say, hey, I'm not going to cooperate, those shares are worthless, so I'll give you a pittance of the price that they're worth. Or if the business is otherwise, where maybe Brenda can hold Susan over a barrel here and say, Susan, I think that the price you're trying to give me here is not enough. I want more and more and more and more. Or it may be that Brenda says, I'm never selling. I want to be in this business, whereas that was never Susan's intention here, to be in business with Brenda. So this is where the buy-sell agreement would override this. We're going to create those terms and conditions in advance, so this doesn't become a guessing game here at death. Obviously, with some of these things, this is going to be easy to insure. So if we're looking at death and disability, for example, we can insure these risks. So the business can actually buy insurance on its shareholders, so that if these things go wrong, then we have a ready pool of cash paid in a tax-efficient manner, most likely, that we can use to deal with the buy-sell need. But where we look at these other set of needs down here, these ones are harder to insure, or not normally insurable risks. So it's most likely, if one of these things goes wrong, that we have no insurance in force. And this is where the buy-sell agreement becomes so important, because it'll say, hey, where are we going to come up with the money? Are we going to have some time to purchase here? That is, if we give maybe 5 or 10 years to the buyer, is that going to be enough time for that person to come up with the money? Is there a pool of money available in the business? So can we borrow or draw funds from the business? Is it possible that we might use some personal collateral here, where maybe the new shareholder and the surviving shareholder, whoever we have, end up making some sort of agreement where they use some personal assets to create some agreement? So we can see that structurally the buy-sell agreement can be quite complicated. It's good to have a rough idea about this. If you do find yourself in a position where this is a need that you're trying to meet, the key here is that you're essentially going to act as a quarterback here. You're going to go and find a good lawyer and accountant, And we want lawyers and accountants here who understand these needs. And this is something that lawyers and accountants, and financial planners for that matter, will generally have a pretty good grasp of. We want to make sure that we're putting in place an agreement that's well written, that considers a variety of possible circumstances. So we see some of the possible things to look at over here, and there are many more possible outcomes that could result in a need for a buy-sell to be executed. We want to make sure that the buy-sell is going to survive. Remember that this is going to be, when Bill dies here, this is going to be a difficult time. This is going to be hard on Brenda, hard on Susan, and we want to make sure that we've got an agreement that's going to weather that storm. We don't want to put them in a position where they now have to go to court to enforce their rights, or they feel like they have to fight because the deal they're getting isn't fair, or whatever the case is. This is where it's so important to write this well right from the beginning. I hope that that's a good examination of buy-sell agreements. I hope that helps you to understand how they work. Like I said previously, there will be a future set of videos that goes into full detail on buy-sell agreements. This video is just intended to give a very broad overview. Thank you very much. Enjoy your continued studies.